Good afternoon, everyone. Welcome to 25 Minutes with Cap. This is the first edition of 2021. And today we're going to discuss the January 1st casualty reinsurance renewals. You know, the only thing that seemed consistent about this cycle was its inconsistency. Different reactions of how to deal with COVID exposures, cyber, silent cyber, social inflation were among some of the hot topics that reinsurers and insurers wrestled with over the last few months. So who better to discuss this with me than Don Bahr, Senior Managing Director, Head of Casualty Reinsurance at Markel Global Reinsurance. Don, thanks for joining.
Well, Adam, thank you. On behalf of Markel, I really appreciate you having me on, and I'm very excited about the 25 Minutes with Cap.
Sure, great. So as we go on from here, as you have questions through the sessions, for those who have joined us, feel free to enter them into the chat. We'll do our best to answer them. And if we don't get to them after 25 minutes, we'll try to send you a note afterward. So Don, let's get into it. So we talked about a few of the headlines that came out of this. What surprised you most about the cycle?
Yeah, well, I mean, first and foremost, it was probably the best 1/1 cycle we've had in 15 years. So that should not be forgotten here at all. But as we entered the reinsurance season, I think there was three main items on the reinsurer's mind, and the first was, I just mentioned, the speed and degree of the change in the market throughout 2020 and then in 2021. A meaningful rate increase. It was generally correlated with those lines that were more troublesome from the loss ratio standpoint.
Right.
For example, D&O, commercial D&Os and excess liability in Bermuda were getting 40–80% rate increases. Other lines that performed a little better, environmental, for example, more moderated rate increases. But I would say the other thing that was really prevalent in the data was the amount of limit reduction, capacity reductions. If a hard market is measured by the lack of capacity, and I will give you just a microcosm, but on some large, Fortune 1000 placements, insureds were struggling to replace capacity from last year, in some cases by hundreds of millions of dollars. They could not get the business at any price. So within the insurance market, very, very hard market in certain areas, not widespread. It wasn't across the whole platform though. But I think we have to look at all that great news we had on the rate limit reductions and in terms of conditions, and two items that stuck out to me were the lingering effects of the soft market.
Sure.
Almost every analysis we looked at had more than expected development coming through, which negated or offset some of the gains we took at 1/1. And I think that's unfortunately not going away. It's something I hear Stephen Catlin out the market kind of repeatedly drumming. And then we just saw a major reinsurer take a significant casualty reserve strengthening this morning. So it's not going away. I think we're going to see more of that in 2021. And the other area was the lack of investment income. Last year we were a little bit more robust investment environment. I think year over year we've dropped 150 to 100 basis points or 50–60% in the investment return. And I don't know that we adequately adjusted for that at 1/1 by many accounts to adjust to push more underwriting margin in to offset the investment income. Need to move combined ratios 5 to 8 points. So I don't know that we got there. I think there's more recognition coming on that side. So while I would say we had a good 1/1, not the time to take the foot off the pedal.
So you were referencing Stephen Catlin's comments. What were your thoughts on those?
I don't disagree generally with him. He's saying we need a hard market for 4 to 5 years, I believe. I would say we certainly needed to sustain through 2021, 22 for sure. We've coming off a really tough 5 years of soft market, and overall probably 10 to 12 years of soft market conditions, but the last 5 have been particularly, I think, brutal.
Sure. How do you view this market as different or similar to the last hard market, 2003?
Yeah, sure. Interesting question. I think every hard market, and this is my third, although I was a very junior underwriter at the 1985 year, but every hard market kind of has its own, I'll say, personality. I think the biggest issue is today versus 2003 is the amount of surplus that's at the insurance company level. In 2003, a lot of companies were, especially smaller companies, were struggling with surplus. Some were probably going out of business, and so there's a real need for surplus relief from the reinsurance market. Today, I think the reinsurance buy for a lot of cedents is a lot more strategic than surplus needed, and so I see a lot of companies. Some companies bought less reinsurance at 1/1/21 because they're bullish on the market, they're bullish on their portfolio, or potentially switched from quota share to an excess loss to retain more premium on their books, on their balance sheet, rather than cede that out to reinsurers. But there was a case where a lot of companies were buying more for strategic reasons as well. Some didn't want to take all that growth on their balance sheet, so they want to cede that to reinsurers.
Sure.
It could be a specific product line, cyber transaction liability, where the limit requirements are higher and they want reinsurance, or just to fund a strategic initiative. So, but I think the biggest feel I had was that this market is really kind of insurance driven versus 2003 being reinsurance driven. And what I mean by that is that it seems like the change in rates, limit reduction, and terms and conditions are being driven by the insurance side of the equation. In 2003, I think that was really driven by reinsurers.
Sure. So you mentioned some of the changes and some of the limit requirements in the cyber business. You've been cautious with cyber since we started working together over 10 years ago. How bad is it right now for cyber insurers and reinsurers? And how quickly does it get better?
Sure. Yes, we've partnered on cyber for a long time, and Markel is a very viable cyber reinsurer out there. We've been in the business a long time, but you're right, we've been a little cautious. Partially to the aggregation and systemic loss potential. We didn't have one of those big events for years. We sort of sidestepped NotPetya and everything else. But the other side was the continuing broadening of coverage, bringing contingent BI. That concerned us a little bit because all that broadening coverage isn't really in the back year's data, so we weren't sure how willing that was, how well that was being priced into the marketplace. And frankly, cyber results were pretty good for the decade, right? I mean, aside from some headline big losses, I think the market adequately funded the product line, and I think they actually adequately funded the Targets, the Home Depots, and those big losses that were out in the marketplace. Today's a different story.
Do you think that it's now priced adequately for the aggregation risk?
I don't know the answer to that question because of the dynamics that have changed.
Right.
It's shifted from a large loss severity exposure to adding in the ransomware, and ransomware has been all over the last 2 underwriting years. It's added a lot more frequency into the equation, which we didn't have before. So
right.
It's in the aggregate data we reviewed, I think it's pushing loss ratios up 5 to 10 points, and this is still an ongoing phenomenon. It's still green, so we could see this going further. So to answer your question, it's probably not currently being funded. It's that the results have been pretty good in the past, but I think these last 2 years are going to be problematic for the industry.
So there's so many cyber insurers out there. They can't. Do they all have the same level of quality? And if not, are you starting to see, or do you think you'll start to see a flight towards quality with the people who have what you're viewing as the right type of risk management, the right types of controls in place?
I'm pretty sure that will happen. I agree. I mean, I think there's some real market leaders out there, and we're seeing them emerge and trying to address the whole ransomware issue, right? I mean, they're driving rate. The rates are up, 20%-ish, maybe even a little higher. Limit capacity. They're kind of doing the same area that the public D&O did a couple of years ago, and really starting to manage the risk and rein in some of the sins of the past. But the one big aspect out there is we're hearing, and it's in the news, co-insurance on ransomware. That's these are all good measures. We'll see. I mean, it's
right.
We're still wrestling with an ongoing phenomenon, but I think what we're trying to address is good. So we'll see where it goes.
Sure. So that's proactive cyber, and then there's a whole world of silent cyber. you know, it's all over the casualty portfolio. People define it in different ways. Uh, how aware are companies, and what are the different levels of their awareness amongst their exposure? Where do you see that? Where do you see that part of the business going?
Very topical. And just to be clear, Adam, I mean, silent cyber or non-affirmative cyber initiatives are response to policies that don't explicitly include or exclude coverage. And it's just silent, and therefore put some ambiguity in the contract. You don't have contract certainty. And, you know, I think the industry is moving toward rectifying that issue, but that doesn't mean necessarily that every D&O policy or every GL policy gets an exclusion. But it's more about identifying, quantifying the exposure so we know what we have, and then pricing to it, right? If we're giving coverage, we ought to be getting adequate premium for it, and adequate return on that. But as to why we need to address it, you know, Lloyd's is being very proactive. Lloyd's and the PS, a PRA, they're mandating cyber that insures affirm or non-affirm cyber on all their policies. And that's probably going to leak out to the broader market eventually. And without clear affirmations, I think companies are going to really struggle to understand what they have on the books. Should we get a big RDS event such as Northeast blackout? I mean, do we really know what the exposure is? And that's going to be critically important to the C-suite, critically important to rating agencies, and selfishly critically important to the reinsurers.
So how far away do you think this is, or do you think it happens where every casualty policy has some type of proactive response to cyber exposure?
Yeah. Well, as we're fond of saying, Markel, it's a journey, and this will be an evolution, not a revolution. So, but it's something that Markel as a whole is certainly looking to address on a company-wide holistic basis. But again, it's going to take some time, because there's some cyber coverage probably embedded in certain lines of business. It's been there traditionally, and just understanding that aspect. So, I think we'll start with some data privacy exclusions in the GL, and we'll branch out from there. I think there's going to be some problematic areas to address, such as ensuing type losses, but. Then again, we're identifying, we're quantifying, and we understand what we have.
Sure.
Not excluding it. So, but I think it's going to gain a lot more steam as we go into 21 and 22.
Sure. One of the things that you brought up before was transactional liability. What are you seeing in this market? This used to be viewed as a very attractive market to get into. Not so much anymore.
Well, first of all, you should know we are a leading reinsurer of transaction liability, and so we have a little perspective on that, and maybe we could back up a little bit and
Sure.
say why there was a big push into the marketplace. In the last few years, there's been a tremendous push to get into the transaction liability space, either on your own balance sheet or via delegated, and more often actually, more delegated underwriting relationships.
Right.
Why were people going in there? I think in the middle of the soft market, transaction liability presented a product that probably had a better chance for adequate margins than D&O, EPLI, general casualty, healthcare. I mean, they're all having their issues. So I think that was a little bit of flight to maybe find some margins, but it meant really a lot more delegated MGA type relationships that you support. So. But in the category of self-fulfilling prophecy, the more demand, or the more supply that chased rate down in the product line, it broadened coverage, and it started to have probably a little pop up in loss ratios for some. Others managed it very well.
Sure.
As to why it might be less attractive today, I think it's the opposite reasons. There might be more attractive places to put your capital. There's a lot more rate and changes going on in other product lines, and I think transaction liability has been fairly steady. It obviously had some top line hiccups in 2020, given the lack of M&A in the second quarter due to COVID, although that's picked up quite a bit. And the market's changing, it's culling, it's evolving, rates are starting to back up. Again, similar to cyber, I think coverage grants are sort of being reined back in, that were gotten a little broad in the marketplace. So for those in it, I still think it's a very viable product line out there, and will continue to generate adequate margins. But others may say, well, put the capital elsewhere than there today.
What's an example of where the coverage got too broad in the transactional business?
Yeah, broadening out to maybe cyber, a little bit broader in the cyber area, where what you're representing and warranting about your security and your cyber, got a little loose. Environmental things. To me, it broadened out to where other insurance policies should be taking over, rather than going into the transaction liability space. I mean, transaction liability is kind of a very, very narrow coverage. It's a specific, M&A, and again, ensuring specific reps and warranties, and the broader, and so. But again, with increased supply, people are willing to broaden those coverages out to write business, and I think we're starting to see a little bit of contraction backwards on that now.
So you mentioned, the COVID exposures, the slowdown of M&A because of COVID. I thought one of the interesting things of the of this 1/1 cycle was how people were addressing or trying to address communicable disease exposure. Some people viewing it as uncoverable, others looking for a path to how you profitably underwrite it. What's your thought in this area?
Yeah, well, it's obviously been high on the headlines for property and business interruption.
Sure.
No crystal ball there, but the property market really tightened up.
The casualty side.
Yeah. On casualty, yeah, it's tough, and I think there's probably certain segments that we need to drill in versus others on communicable disease. I mean, healthcare, where I think you just logically looking at this, you can kind of figure out just really areas that might have a heightened exposure. We can underwrite to it a little bit today, I think.
Sure.
I mean, we know what it is. We've seen what the losses patterns have emerged so far. So we're not out of the woods yet by any means, and there might be more things coming. But I think you can take a logical look and address on a case by case basis in the casualty world. But we need to ask questions. We need to investigate. We need to understand where the exposure is coming from, and there's going to be places where we need to exclude it. And it'll probably start with the ones that are probably most exposed: travel, hospitality, retail. Areas are really going to have to, really prove themselves that they're following guidelines and up to speed on how they're treating communicable disease.
But have you seen different levels of, without naming names, different levels of thoughtfulness from the different insurers in terms of how they're attacking the communicable disease exposure?
Well, you have to be blind not to be thinking about it, right? So I think it's different degrees how companies have responded, how robustly they went after it, and as I said, it's been evolving. I think everybody took a real sharp, pullback in March, April, May, and wait to see how this played out a little bit into their underwriting approach. But yeah, certainly there's some that do better than others. I mean, so
yeah, sure. You mentioned healthcare. You mentioned healthcare with respects communicable disease. I think you've referred to in one of our earlier conversations as healthcare as a social inflation poster child. What's your thought on that business going forward, particularly with respect to reinsurance?
Yeah, sure. So I don't think social inflation is limited to healthcare. I just think it's a good example of social inflation that's very prevalent in general liability, and anywhere you tend to take things to trial, which is impacting overall settlements. To me, it was running rampant through 15 to 18. I think we're seeing the effects of that, as I mentioned earlier. We're going to see some adverse development coming out of healthcare and general liability, and maybe others on social inflation.
Sure.
And I would caution that it sort of left the headlines in 2020 because the courts closed due to COVID. Right. I don't think the underlying elements that were pushing social inflation, it's different jury pools and a lot of different factors going into there, but it's not going away. We've already seen the civil courts that have opened up a large verdict come out of there on the GL side, and the appellate courts upholding large verdicts. So not going away. from a reinsurance standpoint, that seems to fall more on the reinsurance balance sheet versus the insurance balance sheet. Most cedents, a lot of cedents like to, they can handle the frequency exposure. They like to maybe offload some of the volatility and severity exposure, and so it's falling more to the reinsurance platform. On the healthcare side, or anywhere, but again, with any exposure, it starts with pricing adequacy, and that's challenging. We're getting verdicts from policies you wrote 5, 6, 7, 8 years ago, and the dynamics changed, right? So what we may have thought we're pricing adequately, in 2014, clearly we did not, and that's very challenging right now. But so pricing is one thing. Limit management, again, smaller limits, less chance for you having to pay on explosive verdict. And then I think we just need to reevaluate what things we bring to trial. Understanding the jury pools, understanding the jurisdictions. And I would say, Adam, there's no safe jurisdiction out there. Big verdicts are coming out of Iowa and Minnesota and out throughout the Midwest. It's not just California. In fact, California, from a healthcare standpoint, has been very good, with the micro, and Texas, but states that you wouldn't think would have high verdicts, or they were coming out, 2015 and post.
So you think some of the claims teams maybe have been a little too aggressive?
Well, they had a pretty good run. Thinking in the healthcare and the medical malpractice. I mean, a lot of companies, when they go to trial, they've had an 80-90% success rate. And when they've lost, it's not been a nuclear verdict, but that's changed a little bit. When they lost, the verdict was big.
And are you seeing that across the board, more specific to healthcare?
I see it more in healthcare just because I think more of that goes to trial and you read the headlines, but certainly the general liability and the product liability, it's out there. I mean, it's just as bad in general liability as healthcare. Professional a little bit less. I think less goes to trial, but overall, it's impacting settlements. Even if you're not going to trial, it's driving up settlements for every line of business.
You talked a little bit about people moving their money toward better opportunities in the market. What are you viewing as some of the better opportunities near term?
Yeah, so as I said, definitely it's a hard market, especially in the insurance arena right now. And there's opportunities. There's new capacity looking to write deals as well. I probably go where the rate and the limit contraction has been the best. And the public D&O and the excess casualty, I think there's been tremendous opportunities through 2020, 21. But you always got to keep your eye out. We're seeing movement in the other lines of business. Small account, regional companies are moving things. Auto might be an example of something. That's a little tough to read right now because auto, a lot less cars and trucks on the road. That's going to change in 2021. But
sure,
that was a tough line. But that's been getting rate for 5 or 6 years. So.
Right.
Yeah, well, so I think there's pockets out there. I wouldn't say it's a broad brush opportunity. Maybe it was in 2003 where everything was hardening at the same time. I think there's everything's on a bit of a spectrum right now.
All right, great. We've got about 1.5 minutes here. I've got one last question for you. You've always been out on the road, going out and meeting clients. Obviously, you haven't been able to do that for a while here. How do you have the same, or can you have the same type of success conducting business from a conference room or a living room?
Yeah. Well, Adam, I for one, and maybe joined by many here, I'm sick of the Zooms and the WebExes, and I wish we could do this person to person right now, right? I think it'd be a lot more back and forth and good dialogue. But let's face it, the reinsurance-insurance relationship is a partnership, and it's built on transparency and communication. And I just don't know that you get that in an hour Zoom call. I think it's being out meeting with the clients, and it's just not the renewal meeting. It's having a dinner, talking about the business, getting to know people personally, playing golf. I think all those things contribute to the partnership, and I think that's something we're very, very much missing. And I'd also add, I don't think it's healthy for our underwriting employee base being separated. I think there's so much to be gained by being in an office environment, hearing what's going on in other accounts, and especially for our underwriters who are not quite as tenured and still learning the business. Sure.
Well, hey, I really appreciate you taking the time to join us on the call, and thanks everyone for tuning in. If you have any questions, feel free to put them in the chat here, and we'll have this recorded. So thank you very much, and thanks, Don.
But thank you very much for having me. Really happy to share some insights, and happy to answer any questions from the chat room down the road if you need me to.
Awesome.
All right.
Hey, thanks a lot.
Thank you.